Welcome, everyone. We're going to get started in just a moment. If you haven't already, grab your notebook and pen so you can take notes. All right. Good afternoon, everyone, and welcome to From Revenue to Real Wealth, Turn a Good Business into a Valuable One Without More Hours. We're excited that you're here because today's topic is one that resonates with so many business owners: how to move beyond simply generating revenue and start building real transferable wealth. Grab your notebook and pen. You're going to want to take notes. Also, we have designated time at the end for questions, so please put your questions in the chat and we'll address those at the end. It's my pleasure to introduce our two expert speakers, Dawn and JP. Dawn Gottfried is a financial planner and consultant and the founder of AHA Financial. He works with business owners and professionals to create strategic financial plans that align their business success with long-term personal wealth. He helps clients turn income into intentional, tax-efficient, and sustainable wealth-building strategies. JP Van Steerteghem is a certified executive and business coach and the founder of Ascend Coaching Solutions. JP helps owners and CEOs scale their firms by clarifying strategy, strengthening execution discipline, building leadership, strength, and improving operating discipline. With over 30 years of experience in the high-tech industry, he especially enjoys working with technology firms, including IT service providers, SaaS companies, and product development companies. Together, Dawn and JP help business owners increase revenue, strengthen operations, and build businesses that are not only profitable, but valuable.
All right. Thank you, Jenna, for the intro. Welcome, everyone. Today, we're going to show you how to turn revenue into real wealth. Not by working harder, but by understanding the levers that actually create profit, cash flow, and business valuation. We'll be using a profit assessment tool that benchmarks your business across the financial drivers that matter the most: profit, owner pay, cash flow strength, and labor productivity. Most owners are stuck in a cycle of chasing top-line revenue growth without seeing it translate into personal wealth. This session is about breaking that cycle and giving you a clear financial operating system that works. Most owners grow revenue faster than they grow wealth or profit. The gap shows up clearly in the profit assessment. You see good revenue, but weak margins, inconsistent cash, and owner pay that fluctuates. And this is extremely common. However, it is also completely fixable. Revenue is a vanity metric, but wealth is a structural outcome. Today, we are going to show you exactly why the gap happens, and more importantly, how to fix it with a system with a predictable outcome. There are four universal drivers of small business profitability, and you must get all four right to consistently create profit and wealth. The first one is owner salary. Most owners underpay themselves or blend salary and distributions. This clouds up the entire P&L. You cannot know your true profitability until your compensation is normalized or market-based. The second one is profit. 10% pre-tax profit is the new break-even. Below that, the business is operating on a knife's edge. 12 to 15% is where the business really becomes scalable. The third one is labor productivity. For service businesses, labor is the biggest expense and the biggest lever. To build profitable business, your team must produce at 2.0 labor efficiency ratio. What that means is that for every dollar of labor added, you need to generate over $2 of gross profit. The fourth one is there are four forces of cash flow. Taxes, debt, working capital, and distributions determine how cash actually moves and whether the business feels stable or chaotic. First, you got to set aside your taxes in a separate account on a quarterly basis, regardless of when they have to be paid to the government. Second, repay your debts. Get your line of credit to zero and pay off your term debt. Third, build cash by retaining profits until you hit core capital target. Core capital target is 2 months of operating expenses in cash and nothing drawn on your line of credit. Fourth, take distributions on a formal basis each quarter only after you have covered your taxes and hit your core capital target. So these are the four keys that form the backbone of your profit growth plan. So let's introduce a practical way to intentionally grow your profits. The Profit First Growth Plan. The first thing you do is you run a profit assessment. And when we run the profit assessment, the same blind spot appears almost every single time. And that is, profit is taken last, which means it almost never happens. This is where Profit First becomes very powerful because it reverses the formula from sales minus expenses equals profit to sales minus profit equals expenses. And this means that we are reverse engineering your profitability, which forces the business to live within a healthy, sustainable structure. When you take profit first, your business will tell you whether it can afford the expenses you are incurring. It will tell you whether you have the right margins, whether you are streamlined enough. If you find you can't pay your bills after taking your profit, you must address those issues. Review your expenses and address the areas where you're spending too much. As a side benefit, this will force you to focus on those things you do really well, which will attract the best customers and will allow you to grow a lot faster and a lot bigger. So let's get real about your financials and do an instant assessment. Okay, this is when you find out how well or how poor the business is doing financially. Now, Profit First is a cash management system. So that means we don't look at funny money like depreciation or accounts receivable. This is about, did you get the cash or not? Did you spend the cash or not? It's simply money in, money out. And to do it, you got to get last year's P&L, tax return, last year's balance sheet, and then you start filling in the assessment. And again, remember, this is not an accounting exercise, okay? So in the first column, you start off by entering the first line item, which is the top line revenue. The second line item is if you're a manufacturer or a retailer, for example, you put in the cost of materials and the cost of your subcontractors. And then you subtract that from your top line revenue, which gives you the next line item, which is real revenue, which is a real measure of how well the business is doing. Then you write down the actual profit from the last 12 months, which is the cumulative profit sitting in the bank, plus whatever bonus you paid yourself on top of your salary. Then you fill in owner's compensation, how much tax the company paid, and then the operating taxes, expenses, which is the total expenses the business paid, except for profit and owner's compensation. And once the actual numbers are filled in, then it's time to compare with the numbers of very profitable companies in your revenue range. So let's flip quickly to the profit first percentages. And what are profit first percentages? Well, they are ballpark target percentages pulled from a survey of fiscally elite, very profitable companies. This will allow you to compare how your business is doing against those financially healthy companies. And this table here shows target allocation percentages for each line item across different revenue bands, starting at 0 to 250,000, all the way up to 10 million to $50 million. And depending on the revenue band you're in, you pick the target percentages that apply to your business and put it in the instant assessment. And this, again, allows you to compare how your business is doing against financially healthy companies. So after you enter the target allocation percentages, the instant assessment provides an initial indication of how well or how poorly the business is doing. And here in this example, you will see, negative numbers for a line item in the bleed column, which means you're bleeding numbers on that particular line item. You will see positive numbers as well, which means you're paying too much for that particular line item. And then the final column does not have a number. It only has the word increase or decrease. If the bleed number is negative, you put in increase because you need to increase your contribution in that particular item. If it is negative, you put in decrease, since this is a category you need to spend less money on to fix it. And now this is where everything becomes real. The execution plan creates a very predictable financial structure. Okay, you start off by doing a one-time setup. You open a profit account, an owner pay account, a tax account, an OPEX account, and an income account. And then you set the initial allocations, right? Then on a daily basis, any incoming revenue is deposited into the income account. And then you don't touch it. You only touch it twice monthly, on the 10th and the 25th. Those days, you allocate money from the income account to the profit, owner pay, tax, and OPEX accounts, based upon the target percentages that you set. Most importantly, you pay the bills with what is available in the OPEX account. If there's not enough money in the OPEX account, don't pull from the other accounts. However, what it means is that you can't afford the expenses and you will have to get rid of them. And then on a quarterly basis, you take 50% of the accumulated profit as a distribution. Okay, the remaining 50% you keep in the account and is used to build the reserves and stability of the business. And then on an annual basis, you review your target allocation percentages and you adjust those allocations as the business continues to grow. And then you also fine tune your operating structure. So when you follow this rhythm, you follow this process, you create discipline, stability, and confidence. And that is what turns profit from an accident into a repeatable habit. Now, profit first does not replace your accountant. Okay, you still need an accountant. You still need someone to keep the books. However, it will tell you when you have a red flag and where your cash stands at any given moment. You'll know your profitability, your reserves for taxes, what you are getting paid, and the amount that you have in the business to run the business. And now that you're running, consistent profit, it's time to turn it over to Don to explain how to turn that into real wealth. Don?
Thank you, JP. That was great. So, now that you're starting to make real money, real profit, you might say, what now? Is it enough? Am I making enough profit? Am I there yet? Right? And it's common that people will say to me, before or when I start working with them, I think I'm doing okay, but I really don't know. And that's not a surprise, right? You all know you're busy with your business. Obviously, that's why you're here. Likely family, right? Kid responsibilities and stuff. Maybe you're involved in the community. I know business owners who are very involved in the community because that helps them, find new clients, right? So, and maybe you want to get a little rest and do some home projects, right? And there you go. 168 hours in a week can go by really quickly, and people don't really think, so much about where they're headed. And this uncertainty has two impacts, right? One is they have anxiety about it. I'm sure many of you are not immune or unfamiliar with the idea of waking up, at 3 a.m. and you kind of roll over and go, I'm so tired, I got to go back to sleep. But then something pops into your mind, whether it's a client or, making the payroll, whatever it is, and keep you up the rest of the night, make you less effective the next day, right? Because you're tired, because you're concerned because of that uncertainty. And the second one is really, if you don't know where you're going, then, any road will get you there. Or I like to say maybe no road will get you there because you don't know. And again, that uncertainty feeds back into the anxiety, right? So you need to know that you're on the right path, right? And that will give you, more of that confidence and peace of mind that JP alluded to a minute ago. So obviously growing your profit is great, but we also want to be able to see into the future a little, right? And be creating that future. And this points to the fact that the two pieces that JP and I are talking about, making the business more profitable, but also then turning that into success for yourself and your future, really need to proceed in parallel, at least partly, as they're very interrelated. So what are we going to do? So go ahead. Yeah, thank you. So how do you get there? Well, number one is figure out where there is, right? So when do you want to retire? When do you want to sell your business? What do you want to do in retirement? Do you have any sense of what that's going to look like? In my experience, most business owners have very little because their life right now and for the past, and foreseeable future are just like running the business, right? So it's not an easy process. And it's not going to happen overnight, but you need to start it, right? And to start to create some clarity out of what many people have is just a vague, well, I want to retire someday and play golf, And so, we're going to start you down that path. Second is figure out where you are now. That's a key ingredient on where you're going. We need to know where you are and where you want to go. That was step one, to be able to figure out if you're on track to do that. And if you're not, how we're going to get you there, right? And we will get you organized. Number two is actually easier than number one in a lot of respects, but it's not always so easy. It's ironic that with all the electronic capability we have, I find people just have no idea where all the stuff is and how to get it all together. But once we start to find it, that technology can help, right? And from that, we're going to build a model. So now we can show you where you are, kind of how you're doing, what the current trajectory is, and then we can start to do A/B analysis. If you do this strategy or this strategy, or first and foremost, given what JP was just talking about, how much profit do you really need to be able to fulfill on those things that you decided you were going to be doing in step one, right, in the future. But we're going to have that model so that we can look and see, okay, we do this, your trajectory's here. We do this, your trajectory's here. Which one's going to be a better choice? You can start to develop an action plan and help you fulfill in getting there. And at the end of the day, what we're really doing is creating this future. Hope is not a strategy. Well, I hope I'm making enough profit and I'll get there someday and I'll sell my business for millions of dollars, right? And it's a little daunting, right? Because you're not doing it and you're busy, and we know that, right? But by doing this, it really will generate additional sort of inspiration and motivation. I think you get the idea that although conceptually what both JP and I are talking about is somewhat straightforward, right? I mean, it's not obvious per se, but we can help you understand it. But then you're going to have to take the actions and do the work. And the key is, as you start to create your future and it gets exciting, right? And it gives you motivation and inspiration to actually do that work. So go ahead, let's continue. And so let me just give you a glimpse here of the structures that we have access to once we have some vision of where we want to go relative to your business and personal world, right? I have a degree in electrical engineering, and I see everything in the world, in your lives, in our lives, as intertwined. I mean, it really is, right? And so your personal, as you know, as business owners, is not distinct from the business. You have personal expenses you run through the business. So we need to understand that whole thing. And the reason I draw this as a Venn diagram, and this is something I go through with new clients, is to help them evaluate sort of where they are in the different spaces, is that it's a Venn diagram because if we can help you spend $1 to do more than one thing, like 2 things or 3 things, then that can build efficiencies into your business and make you more effective and efficient and successful, right? Tax efficiency is a huge thing. As business owners, that between, like in Massachusetts, where I am, between federal, state taxes, state income taxes, Social Security and Medicare, if you own a business, you pay both sides of that. So that's an immediate 15% right there. Not to mention sales, excise, property taxes. I mean, it, right? So as you make more money and as JP helps you build more profit, you're going to owe more taxes. And that's a good problem to have, right? More money is always better, even if they take a bigger chunk of it. But you'll also have more things that you can do to reduce your taxes over your lifetime. And so it's not just, hey, how do I pay as little tax as possible this year? But it's how am I going to minimize my long-term tax bills, right? And have more confidence. So we'll also diversify cash flows out of the business, right? Many people are familiar with a 401k or profit sharing plan where they can get, roughly $70,000 a year out without paying taxes. But as you make more money, you may want to do more than that. And there are options and structures we can put in place to help you get, $200,000-300,000 out in a year that won't be taxed, right? We'll protect your business. One of the things I see with business owners are really, they've got a large illiquid asset. I've got a business worth $5 million. Maybe I have, 250 or 500,000 in a retirement account, but my big money is in the business, right? And yet it's not generally accessible to me. And so we want to make sure that if something knocks you off for whatever reason, it could be, divorce, it could be disability, it could be death, right? But there's, somebody could get arrested and lose a professional license. How are we going to make sure that this future that we're creating for you, as much as possible, is going to stay on track, whether you're here or not, for your family, for your business partners, for your employees, all the people that depend on this business? And it's a challenge with businesses. And by the way, those structures can be things we can, own by the business, where we can also generate more return on them, for you than just keeping them in your bank account, right? So we're gonna do that, protect that future. And then lastly, access control and flexibility. Like I said, this big illiquid blob, if you will, doesn't necessarily give you access. We're gonna show you ways that you have net worth. We're going to show you how you can access capital when you need it, and give you more flexibility and options to pivot, because none of us knows where life is going, and things change every day. So access, control, and flexibility helps people be more successful, stay in business, and again, fulfill in that future that we're helping you to create.
Hey, thank you, Don, for that great overview. So now we're going to review a case study here, how we are turning a good business into a wealth-building business. This is a company which is founder-led B2B SaaS business with, consistent revenue, a stable customer base, and steady demand. But like many companies, growth has been prioritized over financial discipline. So what that means is that despite strong top-line revenue performance, the business was not generating consistent profits nor personal wealth for the owner. So what did we do? Well, we did implement a profit growth plan. First thing we've done is we are establishing clear long-term financial targets. So the leadership team has aligned on explicit allocation targets for profit, owner salary, taxes, and operating expenses, as we discussed earlier. Secondly, they're making gradual executable adjustments. So rather than forcing disruptive cuts, the plan relies on incremental quarterly increases in profit, owner salary, and tax allocation. And also, incremental reductions in operating expenses. Okay. Third, they have implemented productivity and revenue discipline, which is really important. So they have agreed to a plan to sustain revenue growth at 5% year over year going forward, and on a productivity improvement target of 10% annually, improving through better role clarity, right? A better pricing discipline, and reduced operational friction. So after executing this growth plan, the business will have achieved material compounding results. So operating expenses, the goal is to decline them towards the 65% target in 3 years' time. The owner will receive a consistent market-based salary. And then they will also start doing quarterly profit distributions that are predictable and repeatable. And the goal is to increase the business valuation to 1.7 million in 3 years. So most importantly, the company will have then transitioned from a founder-dependent income vehicle to a sellable financial or financeable asset. And, this is what Dawn is going to review with you, how to turn that profit into wealth over time.
Yeah, so what I have here is I plugged in the business case study that JP shared with me into a case that I had. It was a hypothetical case with a husband and wife, with the wife making about $200,000 a year in a corporate job, and then the husband making 120, out of the business. Wasn't very profitable. He was sort of steady at that, even though growing revenue wasn't making any more profit. And I think you all understand that a business is valued primarily based on the profit that it can generate. There's other factors, obviously, right? But the whole EBITDA line, earnings before income taxes and depreciation, but it's earnings, which is another word for profit, of course. So this business was worth about $200,000 and not growing. So a couple wanted to retire. 7 years later, they were in their mid 50s. And you see that green there. So what this is their liquid net worth. Can't live off your real estate or your business if you can't liquefy it. So the way people liquefy a business is they sell it. It then adds to their liquid net worth. In this case, it jumped by 200,000. And you can see the trajectory here. This is running out till 90. Realistically, we should be running people to 100 now. An average, a couple in average health, at 60 years old, 50-50 chance. Their life expectancy as a couple is 50-50 that one of them lives into their 90s, right? And that's only likely to keep growing, as we move forward, right? So this was an unsuccessful plan. They were out of liquid cash, maybe they had some houses and stuff they could sell, but we don't know that at this point. So this is our baseline. So let's go to the next slide. So lo and behold, JP comes in, helps him. He mentioned the business was worth 1.7 million after 3 years. In this case, because I'm looking 7 years out, and I can put the growth of the income and the business, because I was having this person keep 50% of the new profit in the business. So the software understands that it's going to continue growing in value just by virtue of those additional savings that are staying in the business. It's worth $2.7 million, and this is conservative. I didn't reduce expenses as quickly as JP did. And this doesn't include any of the strategies that I was discussing in my Venn diagram there that are going to improve this even more. But the point is, that's irrelevant at this point, because you can see, one picture is worth 1,000 words. This was obviously a big success in this example.
Great. Thank you, Don. And, I'm available to do a free profit assessment for anyone who's interested. Feel free to take a picture of the QR code or to take down my contact information. I'd be more than happy to sit down with anyone who wants to do that.
And I have the same. My QR code goes to a scheduling link for a 30-minute free consultation. Would love to talk with anybody and learn more about their business and their situation, and see if there's a way we can help you.
Yeah, and before we thank you for attending the webinar, are there any questions that the audience has?
Yes. First question is, how long is an engagement and how long does it take?
And that would probably, go ahead, JP.
No, I was good. How long is an engagement? So, to set it up, the engagement can be very, quick. Do the profit assessment. That can be done in weeks. But then, of course, the key is execution, right? Execution can, is going to take years, and it's more about, taking on new habit. Right? Following a certain process consistently that will get you to the profit levels and the business valuation that you really need to accomplish in order to build the wealth for the business that you need to get in order to retire successfully. Don, you want to add anything?
Yeah. I mean, for my part, in general, I look to build, lifelong relationships with clients. And, if we take it in the context of, what JP's doing, what I'm doing, let's say I did engage up front. I can imagine that doing an analysis of sort of where you are and some ideas of what you need for profit. And you look at that and say, okay, we need to go back and work on that. That maybe it would be a limited initial engagement. And then as you, embrace the profit first methodology and see real improvements, and, we can engage further. But, in general, I'm looking for it to be ongoing. Things are always changing for people. It's always shifting. So once you have the plan, now we have to monitor and adjust, because, you can be off a little the first year, but if you don't pay attention and correct that, then you get off by a lot. So yeah, that's all.
Okay, we have time for one more quick question. How do you reduce operating expenses by 30% over 3 years without shock therapy, layoffs, or destabilizing the business?
Yeah, so I'll take that question. So it's when you hear the number 30% reduction, the brain immediately goes to layoffs, disruptions, and pain, and so on. But we're not really looking at shock therapy here, right? We're looking at reducing expenses over a period of 3 years, 30% over 3 years. That means that we're improving 1 to 2% each quarter, and then it becomes a lot more manageable. And if you think about, reducing your OPEX over that period of time, you look at labor, okay? Well, over a 3-year period, most businesses have like natural turnover, right? Many businesses, their turnover is 10% over 3 years. So whenever that happens, when someone leaves the organization for whatever reason, It may be a great opportunity to look at opportunities to automate what this person was doing, to maybe consolidate roles, to elevate other talent in the organization to take on more than what they currently are doing. So there's a lot of ways to do that in a very painless fashion. When it comes to other OpEx expenses, it's about reducing complexity, right? Many organizations are running so many tools. There's so much redundancy in tools, software tools, and so on. So maybe it's important to think about improving inefficient processes, remove redundancy out of the organization, right? And improving that 10% over 3 years, I think that is very reasonable. And last but not least, I would say it's all about being disciplined as it pertains to maintaining your margins and keeping your pricing at the right level, making sure you're selling to the right customers. That's why it's important to have an ideal client profile, selling to the really good customers, right? Having a clear focus on your value proposition, on your ideal client profile, will allow you to grow much bigger than if you're not focused on those things. So those are some of the things you can do. And as a business coach, I work with businesses all the time to help make that possible. I hope that answered the question.
All right, we are out of time, and we want to respect everyone's time. We still have a few unanswered questions, so we're going to reach out to you directly to answer those. We hope you are each walking away with something valuable that you can put into action right away. And don't forget, Dawn and JP are here to support you with your success, so be sure to connect with them.
Thank you.
Thank you.